Hi, and welcome to part 2 of Chapter 9, Market Efficiency and Behavioral Finance. So where we left off, we left off on belief perseverance, where investors are more likely to reinforce their beliefs and avoid information that conflicts with their beliefs. Okay, so let's move in and continue with other investor behaviors. One is anchoring. So this is where individuals are going to try and estimate or predict an unknown quantity, and they place too much weight on information that they have at hand. So could be information that's not very useful. It could be old information, but something that they're trying to predict the stock price based on this information that they anchor on, hence the name anchoring. So they might try to predict something about the growth of sales based on information they know on the past rate of growth. And they might try to estimate the future market returns based on past returns. So they're anchored or tied to an obsolete or outdated piece of information that keeps them invested in the stock. And sometimes this anchoring could be a belief in a past management that may no longer be there, or belief in a certain product that might be becoming disrupted. And so this anchoring is just really having a closed mind. You're not really open or accepting new information. And that's going to be very dangerous when trading. There's also a familiarity bias where investors are only engaging in stocks that are familiar to them. Whether or not the stocks may be good or not, this leads investors to hold sometimes a slightly undiversified portfolios. So for example, you might have, I used to work in the semiconductor industry, and I had a colleague where he pretty much only invested in semiconductor companies because that's what he knew, that's what he was familiar with. And at some point in the year 2000, semiconductors crashed very hard. So having a lack of diversity and having 100% faith that his idea was, semiconductors are only going to be in more demand because this is what computers run on, and it's going to be more devices, and this is going to be great forever. Well, he wasn't necessarily wrong in the long term, but in the short term, thinking that semiconductors is the only place to be invested in, that definitely hurt his portfolio. Okay, so how does this market behavior, how can this affect securities analysis? Well, it's something to be aware of, and behavioral finance, which is definitely looking at the human factor, the psychological factor, the way people think, and how they make similar systematic mistakes, can help with, if you're a technical analyst, can help with the reemergence of certain patterns. So those mistakes that investors make are something that's continuous. So you see these patterns pop up over and over again. Now, why is this a pattern? Well, typically the stock market, from what I've seen, you have booms and busts in stock market, bear and bull markets. And during bear markets, a lot of investors will just give up on individual stocks. Bear markets are really cruel and punishing, and you lose a lot of money, and you just feel like, I haven't made any right decisions, and you just capitulate and you sell out of individual stocks, and you just say something like, I'm just going to go invest my money in mutual funds, or I'm not going to buy any individual stocks anymore. Yeah. Then in the bull markets, when stocks start to do very well and it hits the news, stock market return this much, stocks are doing great, and people see stocks that go up 10 times in a matter of a couple of years. This draws a lot of new investors come in, and a lot of investors run into the market. They have initial success and sets them up for when the stock market corrects or has a bear market, that they're going to leave the market and a new generation So it's really the rare person who sticks with it in good times and bad times and learns and continues to trade and make trades and learn and grow. So that continual basis of new investors being added to the stock trading world, and this is only accelerated with the stock trading apps that make it very easy and convenient to trade frequently on your smartphone at zero cost. And the unbelievable stories of people getting rich and doing very well in the stock market have, certainly increased by magnitude of millions of people now trading stocks with very little experience. So these repeating patterns of new investors being discouraged, and a new batch of investors coming in, all these small investors continue to make these same mistakes, excuse me, which create an opportunity for other investors to profit from these patterns. Okay, so how can you use behavioral finance to improve investing results? Here's a couple of well-documented suggestions that could help influence your returns. By following some of these guidelines, you can avoid some mistakes that many investors have made and improve your portfolio performance. A lot of these mistakes I've made myself and learned the hard way. So maybe you can learn without losing a significant amount of money like I did. And that's the reason I became a better investor, is that I made all the mistakes early on, thankfully with a small amount of money. So now that I'm older and investing in a larger portfolio, I hope that I've learned or made most of the mistakes already. And that's why sometimes I would say to people, don't expect to make a significant amount of money for the first 5 years you're trading. This is your learning phase. This is where you're making mistakes and you're learning what's working, what's not working, and you're busting through your behavioral limitations. And, hopefully after that 5-year period, you start becoming more of a consistently earning investor. So anyway, number one, don't hesitate to sell a losing stock. So if you buy a stock and it goes down, your first instinct might be to buy more of it. And this is called catching a falling knife. So the better thing to do is sell the stock and then put that money in a better stock. So what this basically means, if the stock just isn't doing well and the stock price continues to fall, there's no point in owning it or owning more of it. It'd be better off having that money in a stock that is performing well. So if the stock, and this is why some people have these trading rules where if the stock price goes down by 10%, just sell it and move into something else. And I would say that'd be good advice for, certainly if the stock has a good long-term perspective, you want to hold on to it. But if you're trading in sort of a higher frequency, and you're a pretty active trader and you just put some money into a position that does not hold a lot of promise, don't hold on to it just because it went down and give into that loss aversion. Sell it. Don't chase performance. And this is what a lot of people do with mutual funds. They buy the best performing funds the previous year. And oftentimes, there's been plenty of studies that if you buy, one of them is called the dogs of the Dow. If you buy the stocks that went down or the mutual funds that went down the most in the previous year, they typically do better next year. And the stocks or mutual funds that did the best last year typically don't repeat that performance. So chasing performance typically doesn't lead to better results. So you want to be wary of trying to buy those very hot stocks or buy those very stocks that very perform so greatly. Typically, you might be buying at the top of those markets. And lastly, which I think is most important, because rule 1 and 2, don't hesitate to sell a losing stock and don't chase performance. That's not going to be 100% correct all the time. There are times where you sell a stock that went down and it does go up higher a couple of months later, or you buy into stocks that are hot and they do continue to go up. I mean, that's all about momentum trading, right? So, but this last one I think is the most important to help improve your investing, is to be humble and open-minded. Be humble. Just acknowledge you don't know everything. be open-minded, meaning that you're open to new ideas, that you can learn from other people. Be willing to listen to people who have different opinions than you, and learn from your mistakes. Admit your mistakes. Say, okay, I've messed up. What action can I do to fix this? And then try to get definitely a cross-sectional information from many different sources and opinions. So look at people who are saying the market's going to crash and the market's going to continue to go up. What do they observe? Both those, read both those articles, and try to be humble in the way that you're not going to push any information away. You're going to try to collect and review as much information as you can, and be open-minded to the fact that I could be wrong. Let's see what they're saying. Maybe they have a good idea or perspective. So don't be stubborn in your trading. Try to, because the trading environment and trading dynamics are mutable. Things change, situations change, stocks, perspectives, and performance change. So you need to really be open to that. So review the performance of your investments on a periodic basis. I would say, every 6 months would probably be good, maybe once a quarter, and some people once a year. But, sometimes you do have to make changes in your portfolio. There's some stocks that they're not going to come back. They are done. So you don't want to leave your portfolio on autopilot. You really want to review and say, is this still a stock for the long term, or is this stock pretty much not going to do much in the future, and trade accordingly? But keeping that in mind, you don't want to trade too frequently. So you don't want to be making trades every day or even every week. So you want to keep your trades down to a handful, because most of the times when you do trade stocks, you're making a mistake. So if you have good companies and they continue to be good, you want to hold them for long periods of time to really see what they can do. Companies that clearly their business is shrinking or the competition has gotten really stiff, you may want to move your money elsewhere. There could be better opportunities. So you want to trade appropriately, not too much and definitely not too little. So let's bring this over to technical analysis. This is one of the two big forms of valuing stocks. So you have your fundamental analysis that we went over last chapter, and then you have a technical analysis that we're going to go over today. And this has nothing to do with financials. So if you hate financial statements, if you hate financial ratios, if you hate accounting, technical analysis is for you. And it actually is pretty popular. If you watch any of the news shows, like financial news, ever see them put up a balance sheet? Ever see them put up an income statement? No, they're generally they put up stock charts, and they talk about price movement and momentum. So most of the financial news, when they talk about stocks, they're talking technical analysis. And there are many people who believe that this is useful and it works. Now, for myself, I use a combination of fundamental and technical analysis. I use fundamental analysis just to get a better understanding of the company, make sure the balance sheet is solid, and look at how their operations work, and it gives me a better insight into the company. But I might use technical analysis to help determine what would be the best time to buy the company. So for me, fundamental analysis helps me to select what companies I feel are the best, and then technical analysis helps me determine the best buying opportunity, the best time to buy the stock. And what technical analysis really is just, looking historical records of stock price movements and return patterns, hoping that these patterns are going to repeat, or believing that these patterns will repeat. So if you can spot, it's basically seeing a signal that's going to give you an opportunity to buy to earn better returns. Think of it this way. Say you're, before there was the weather station or the TV or the news or weather reports, how would someone predict what the weather is going to be? In some cases, weather is unpredictable. There's really no sign, and it goes from, sunny and warm to rainy and cold. But sometimes some people, they would look at the sky, see certain colors in the sky, or see certain movements of animals. There would be signals, little signs that let them know that the weather is going to change. It's going to become cold. It's going to become hot, things of this nature. Now, Technical analysis is sort of similar. There are signs that investors recognize, and when they see these small signs, they get an idea of whether or not stock prices are going to move up or move down. So technical analysis is controversial because we're basing it on patterns, and there's no real research that says that patterns will definitely replicate. Now, since we're focusing on price movements, we're trying to use this to predict the future returns. And it's definitely going to put you at odds in any efficient market hypothesis. They're all against technical analysis. Weak, semi-strong, and strong, all against technical analysis. But what we want to look at is we want to try to measure the market, try to figure out some trading rules, and interpret charts. So let's talk about measuring the market. So technical analysts are going to argue that the internal market factors such as trading volume, price movements can reveal the future direction of stock prices. Sort of like, think of a fortune teller who's looking at the crystal ball or looking at the tea leaves and using patterns in the crystal ball or patterns in the tea leaves to predict the future of stock prices. Or think of an astrologer who looks at where the stars are going to go in the constellations to predict what your future is going to be. These are all pseudosciences that, there's no real evidence to say that that's correct, but there's certain people who really believe that this is, the outcomes really do match the predictions. Now, for investors, we can use charts and other market statistics to help us put together a technical analysis for an individual stock or a market. And in general, we believe that these will be signs to the direction of the stock price in the market in the future. Now, if we're going to measure the market, one thing we can do, so measuring the market is really trying to gather up the information to know technically, is the market going to be moving higher or lower? And the confidence index is one such measure that we could use to capture the overall tone of the market through bond returns. So we're going to look at a ratio that's going to reflect the spread between the average yield on the high grade corporate bonds relative to the yield on the lower grade corporate bonds. So the confidence index is going to be the average yield for a 10-year high grade bond divided by the average yield for the intermediate bond. So a rise in this index is going to be interpreted as a positive sign for stock future returns. So what we're trying to measure here is if this confidence index is going up, investors are more confident. And and we're seeing a spread, an average spread between the high grade bonds growing, the size of the spread growing from the intermediate to the high grade bonds. So this gives an idea of how investors are feeling. The basic concept here is that investors become more confident about the economy as they feel the economy is going to be doing better and better. They'll be willing to invest in riskier bonds, driving down their yields. As you buy these bonds, the yields go lower, and this pushes up the confidence index. So if you follow this index, you're going to interpret a rise in the index as a positive sign for stock market returns. So this is really just expressing confidence in investors, in companies in the marketplace. Now, part of this confidence index is that we believe that the smart money is revealed in the bond market before it shows up in the stock market. So that's sort of what the belief is. So the confidence index will rise before the rise in the stock market. So it's a predictor of where the stock market is going. So it's a way to use the bond market to help predict the stock market. Now, one, I think, drawback of this would be the fact that the Federal Reserve of some countries have been manipulating interest rates. And with that manipulation of interest rates can kind of make the bond market a little less predictable as these Federal Reserves around the world tamper too much with money supply and interest rates, which can kind of make the confidence index not as powerful as a predictor as it once was. Now, we can also look at market volume. So market volume really just shows the amount of participants in the stock. and the level of participation. So it's really a reflection of how interested or how involved investors are with a particular stock. So if you have increasing volume, so volume is increasing and the market is rising, that's overall a positive sign. This upward movement in stock prices should continue. So if you have a day where there's very heavy trading measured by volume, and volume is measured by if you buy, say someone buys 1,000 shares of a stock, and then somebody else buys 1,000 shares of the stock, right? So that's 2,000 shares so far. Then someone sells 1,000 shares of a stock. That's a volume of 3,000. So all the buying and selling gets added together, and that becomes the overall market interaction or volume. So when we see high volume, that means many investors are buying into the direction of the market. So the market's going up in high volume, that's very good. Now, when stocks have been moving up and down on volume and we see that volume start to drop off, that's a signal of the end of a bull market. So if stocks have been moving up and been doing it on stronger and strong volume, and then we start to see stocks move up on weaker volume, and the volumes are suddenly much smaller, that could be a signal that stock prices are about to go down. And it's easy statistically to track various market volume indicators. And it's reported widely on many sources. And many quotes on stocks will give you the volume on the stock at the end of the day, during the day, and it'll even show you a market average versus today's trading. So it's very easy to get this information for the market or individual stocks. Now we could look at the breadth of the market, and so we want to see the number of stocks that are going up, which we call advances, compared to the number of stocks that are going down, which we call declines. So if we have, say we have the S&P 500, we're just looking at those stocks, and we could say 300 of those stocks went up today, 200 went down. So overall, more stocks went up than went down. So the number of advances compared to declines is going to reflect the overall sentiment. If we have a day where all 500 stocks in the S&P 500 went up, that's probably the most bullish or positive day you can have, the most strongest market. And if you had a day where all 500 stocks went down, that would be a very weak market or declining market. I don't think you've ever had a day where all 500 stocks went up or went down. Maybe days where it was close to that, but not 100%. I've never seen it. But you can get data on advanced declines. It's widely available. Yahoo Finance definitely lists that. So here is some market statistics. This is a little hard to see. And this again comes from Yahoo Finance, which you can get a lot of this, pretty much anything we're talking about in this chapter we can get from Yahoo Finance. So let's make this a little bit bigger. Okay. So here is on any particular day, the number of stocks that are advancing and declining for each of the three markets. And then we can get the total. We can get the number of stocks at the new 52-week highs versus stocks at new 52-week lows. So of course, if we have more stocks advancing than declining, that's a good thing. If we have more stocks hitting 4 52-week highs and hitting 52-week lows, that's also a bullish sign. And we can look at the volume of the stocks that are advancing compared to the volume of stocks that are declining. And we can also look at stocks that are unchanged. So this gives us, and we can look at the total volume. So again, this is just going to give us an idea, a technical idea of what stocks are doing. And they're definitely, we're going to say they're bullish if more stocks are advancing and more stocks are hitting 52-week highs. That's on high volume. That's a bullish sign for the market. Should continue. Now let's look at short interest. Now, luckily, when the whole big to-do came out about GameStop, and this was something that happened not too long ago, but there was a group of investors through a bulletin board, or I think it was Reddit, that started disseminating information about how GameStop had a high short interest, and a lot of their shares were sold short, and this prompted a number of small investors to buy the stock, and then we see the short positions attempt to cover their positions, and the stock market, the stock moves from $10 a share to $300 a share, something incredible like that. So what they were talking about is they noticed, and they did this for a number of stocks, that when a company it looks like it's in trouble. So GameStop's in trouble because now they anticipate most games will be downloaded and sold through a download rather than a store. If they look at, when you had a lockdown, you look at companies like cruise companies, airlines, movie theaters, and a lot of analysts will say, okay, these companies are all going to do badly based on the current situation in the world. Sell them short. Now, and that's usually a pretty easy win for a lot of hedge funds. However, at a certain point, if these companies make a turnaround, if things turn around for them, the stock price is going to go up, and these investors are going to have to cover their short position, which is like adding additional buying. So when someone sells a stock short, it counts as a sell. So if you have regular people just selling the stock and other people borrowing shares and selling it short, it's sort of like a double pressure on the downward price of the stock, which in itself can actually put some companies out of business if they rely on that stock to secure borrowing, or they rely on the stock to issue new shares to raise funds. This could be really detrimental to companies. So the short interest is simply going to measure the shares of stock that is sold short in the market at any point in time. So typically stocks, their short interest is single digits. 1 to 9% of the shares may be sold short. But some stocks, it could be 25, 50% of the outstanding shares are sold short. In that case, that does give an opportunity. If things turn around, the stock price is going to move up pretty quickly as investors cover their short positions by buying the stock back. So there could be two different interpretations here. We can measure the future demand for the stock. So a strong market, so it's a strong market when short sales are high, since guaranteeing that the stock's going to have to be purchased to cover in the future. So a stock that has their short position overdone, which is just too high of a position for the stock, eventually that's going to be reversed. Now, if we measure the present market's optimism or pessimism, the weak market is going to be when the short sellers are high, since professional short sellers think the market will decline. So this is one thing we can look at, the overall percentage of shares sold short in the marketplace. And if this starts moving up, so we see over a monthly trend that's going from 2 to 3 to 4 to 5 to 6%, we see this increase in short positions. This is typically the more the hedge funds and professional money predicting the stock market's going to go down and selling short now to take advantage when the stock market actually does decline. So this measures. So for me, I've used this before where I've seen a stock where they had a very high percentage of the sales sold short, which punished the share price to the point where it was kind of ridiculous, And I particularly remember a company, Shake Shack, that came out, was a sensation as an IPO, went up to $100 per share, and then quickly, when growth wasn't going to be as fast as investors expected, or they realized that they kind of overvalued the IPO, the stock quickly crumbled to about $25 a share, and the short interest skyrocketed up into I don't know for sure, I'm going to say 30-40% of the shares sold short. So this was kind of odd for a company that had a good future. They were still expanding, opening new restaurants. The customer reactions and the store sales were good. Why was it sold so aggressively short? Because, the professional traders got a little bit carried away, and eventually, yes, that short position came down and the stock went back up over $100 per share. But that took took a while before that occurred. So when you make an investment like this based on a short interest, you have to sometimes, closely monitor the situation. And in some cases, it does turn around. It can turn around quite fast as these shorts recognize that they have to cover their positions. Now, there's also something called odd lot trading, which is many small traders making transactions in fewer than 100 shares. So professional traders make trades of 100 shares or more. So this is a contrarian opinion. So we believe that small traders who are trading 5 shares, 10 shares, 25 shares, 50 shares, they always make mistakes. They always make the worst trades. So if we measure the amount of odd lot trades in the market, we can assume that the small investors will do the opposite of what should be done. So they'll panic and sell when the market is low, and they'll speculate and buy too aggressively when the market is high. So if we look at the percentage of odd lot trading, and we see that the percentage of odd lot trading is increasing, we can use that as a signal to do the opposite. So if we see that there's an ever increasing amount of odd lot trading, and speculators are buying, the market is high, maybe in a bubble, and we see most professional managers are selling or not buying, but the small investors are picking up the baton and doing most of the buying, this is a good sign to get out of that market. And vice versa, when it looks like the small investors are selling aggressively and running out of the market, this is a good sign to go into the market. So this odd lot trading goes hand in hand with the contrarian opinion of do the opposite of what the small investors do. Because the small investors are looked at as like the sheep. So you see one sheep jump off the cliff, all the sheep start running and jumping off the cliff at the same time. Now let's look at some trading rules and measures. So market technicians, they're going to look at supply and demand to see what's driving the stock price and use a variety of mathematical equations to measure the underlying market. So they're going to develop some trading rules to help them buy and sell stock when it's most appropriate. So let's look at some of these rules. We can look at the advanced decline line. So this is the difference between stocks closing at a higher price advancing versus stocks closing at a lower price than the previous day. So we can plot this on the graph. And as the graph is rising, the advancing issues are dominating and the declining issues are weaker. So the analysts would say that this is a strong market and you should buy into a strong market. So the advanced decline line is a good way to signal to buy the market or sell the market. So it's about momentum. If the market continues to be strong and the advances continue to be higher than the declines, you want to buy into that market. Now, if we're looking at 52-week highs and lows, we want to look at the number of stocks that are hitting their 52-week high versus the number of stocks hitting their 52-week low. So we could plot this on a moving average. So you basically can take the 50-day stocks, say there's 50 of them reach a new high, 20 of them reach a new low. The difference is 30. Plot that in the stock. The next day, 35 stocks hit a new high, 25 stocks hit a new low. The difference between those two is going to be 30. 25. Well, let me say that again. Say the 52-week highs are hitting 60 and the 52-week lows are hitting 20. So that's a 40, the difference of 40. 60 minus 20. So you plot that in the next day and you can draw a line from the previous day at a 30 up to the next day at a 40. So you have this upward trend. So you want to, buy when there's an upward trend of stocks hitting more 52-week day highs. And you can actually even plot a 10-day moving average to graph this trend. And the idea is that you want to buy stocks when the market is strong and the number of new highs are continually to outnumber the new lows, hopefully in an upward sloping pattern. And the opposite is true of that. It's a weaker market when the lows are going to outnumber the high. Okay. Now there's also this ARMS index. And we'll call this this trading index or a TRIN. It's going to combine the advanced degree line with the trading volume. So what we would do here, let me just make this a little smaller. We would take the number of stocks trading higher, and then we would divide that by the number of stocks trading lower. And then we divide that by the number of stocks moving up on volume versus the number of stocks moving down on volume. So a strong market is going to be characterized, of course, by more stocks having a rising price than a falling price, and having the market having greater volume in rising stocks than in falling ones. So the higher the trend value, if the trend value is high or moving higher, it's going to signal a weak market. So this is, again, just kind of grouping together, put together the movement of stock prices and the volume into one index. Now, the mutual fund cash ratio, what we're looking here is, think of mutual fund managers. They're generally a smart, experienced group of people who are trading stocks. And they will start to build up a cash position as an indicator of where the market's going. So it's going to measure this percentage of mutual fund assets that are held in cash. So we just take the mutual fund cash position and divide it by the total assets under management to get what's called the MFCR, which is the mutual fund cash ratio. So the higher that the cash ratio is, the stronger the market. And we're basically saying that if a mutual fund has a high cash position, it provides them with a lot of liquidity to buy stocks in the future, or to protect them, and also protect the mutual fund from withdrawals. So the way I look at this is, if these cash positions are starting to increase, this would be mutual fund managers not buying stocks or selling some stocks in anticipation of a market decline. When the market actually does start declining, when these cash positions peak and the market has significantly declined, you can expect that these mutual fund managers are going to now start buying stocks that with this huge cash position and the market being so low. And when these cash positions start being deployed, we can say that is going to, these high cash positions is going to fuel the repurchasing of stocks. So it's really kind of gauging what these mutual fund managers are doing, because they definitely want to have a pool of cash in case investors want to sell their shares in the mutual fund. So they don't want to have to be forced to sell stocks that they don't want to sell. They want to pay them out of cash. And that's another reason for building up these cash positions. Now let's look at on balance volume. So there's another momentum indicator, which is going to look at volume to price change. So it uses the trading volume in addition to price, and tracks the trading value as a running total. So the up volume occurs when stock prices close higher, and we add this to the total. The down volume occurs when stocks close lower, and we subtract this from the total. So, and the direction is going to be an indicator of the overall market. So if we have a day where the market's up, we add the volume. Another day the market's up, we add that volume. Another day the market's up, we add that volume. Then the market goes lower, so we're going to subtract the volume from that total. So this is this on balance volume, where it's going to create sort of like a smoothing trend. So we can see that the bull market's going to be when this on balance volumes are higher, and the bear market's going to develop when this balance values are lower. And we can plot this in the chart as well. Now, relative strength and relative strength indicator, these are two measures that are useful in technically looking at stocks. So what is the relative strength index? Well, it's going to measure, basically measures the strength of a security and how it advances and declines over time. So it's going to indicate a momentum of strength into the buying or selling of a security. It helps identify the extremes of a marketplace when things are overpurchased or oversold. So the formula, here's the formula here in equation 6.9, where we take 100 divided by, we'll start in the parentheses. First, average price change in the days up divided by the average price change in the days down, plus 1. And then we take 1,000 divided by that, and then we subtract 100 from that. And it's going to give us a scale in a range of 0 to 100. So when this RSI is below 30, we'd say that the stocks are oversold and it is a good time to buy. And when this RSI is above 70, we'll say that stocks are overpurchased and is a good time to sell. Some investors may use a 20-80 rule. So if the RSI dips down to 20, the stock has definitely been oversold and it's a good time to buy, because statistically it should turn the other way. And if stock goes above 80, that would be a more conservative time to sell because the stock has reached a peak. And this RSI is something that you can easily plot too. And you can use Yahoo Finance. If you go into their chart section on Yahoo Finance, they'll have an RSI tool, which you can plot a separate chart of the RSI. Okay, speaking of charting, this is, if we look at the movement of stock prices, we can place that on a chart. So technical analysts can look at this chart over a month, a year, 2 years, and it'll start to show a visual summary of the stock price. And that can provide information about trends that are developing and the future price movement of the stock. So these price patterns, they start to evolve and they start forming into these chart formations. That's going to give us a signal of whether to buy or sell the stock moving forward. So these patterns, what we're looking for in these patterns, are either support levels or resistance levels that are going to give us an idea, is it time to buy or sell the stock? So when the stock is breaking through a resistance, that's a good time to buy a stock. And when a stock is breaking a line of support, that's a good time to sell a stock. Here's an example of some of the patterns, which would be, let me make this a little bigger. Okay, so here we have we can draw this sort of these two parallel lines, which will show a historic support. So the stock drops to this level, it's supported, stock price moves up to a resistance, it can't penetrate the resistance, so it falls back down to the support. So the stock may bounce up and down from resistance to support pretty routinely. And then one day, there's a breakout where the stock actually breaks above its historic resistance. That's a very strong buy sign, because that means the stocks should continue to go up. And we call this a triple top, because it's 1, 2, 3 tops and then a breakout. Now, a head and shoulders would be sort of like the opposite, where we see this, there's a shoulder here, and this would be the head. So we see this peak is a little bit higher than the first peak, and the second peak is a little bit lower than that. The third peak is a little bit lower than the second peak. So we call that a head and shoulders. And if the stock breaks below the support line, then that's a breakout below, a good time to sell a stock. Now, you might see these triangle patterns. So if you have downward triangles, that means the stock prices can continue to move lower. If you see a flag or a pendant in the stock trading chart, that usually means an upward trend, a momentum, a buy sign. You can have these consolidated triangles, which if it breaks above support or resistance, that would be a buy above resistance, and a sell that breaks below support. But typically what you might have is a breakout and then a pattern and then a continued breakout. Now an inverted saucer, think of like a cup, an inverted cup, this is definitely a sell signal. So these are just some chart patterns, some common chart patterns that technical analysts will look at to try to get a better idea of where the stock prices are moving. Now, you can also plot on a chart what's called a moving average. So a moving average is a smoothing trend, sort of, and it's simple. It's kind of, you should, if you don't know what a moving average is, it's really just, say you take 30 days of stock price, add them together and divide by 30. Okay, day 31 comes. You subtract the oldest day from the group, add the newest day, and then divide by 30 again. So you're always having 30 stocks. But as time moves forward, you're just keeping the most current 30 stocks and dividing by 30 and plotting that on a chart. And you can do this, it's going to smooth out the price movements. And this is typically done over periods of 10 to 200 days and plotted on a chart. So by plotting these smoothed out moving averages, we can sort of better develop the support and resistance levels. And so when a buy signal is when the security breaks above a moving average, which would be considered the resistance, and a sell sign would be when the security price moves below a moving average, would be more of a support. So if we look here, here is the closing prices of a 100-day moving average, and we're looking at, so the red line is the 100-day moving average, we can tell because it's much smoother, and the blue line is the closing prices. So we see here that is what we should normally see, that the stock price is trading above the moving average. Once that stock price touches the moving average, goes below the moving average, that would be a sell. And if it goes back above the moving average, that would be a buy. So you can see here that there was just really almost a sell and a buy, which really didn't do much other than reinforce the fact that you should own the stock, and it did move up. So this is sort of, can even be thought of like a bounce or a touch on the moving average. Now, when the stock actually goes below the moving average, you should sell. So here would be kind of confusing because you would be selling, buying, selling, buying, selling, buying, and then selling. So that's a lot of trades. But eventually, that last sell, really, you wouldn't buy it back because it never went above the moving average again, and you would be able to avoid this huge drop in the sell price. But then eventually, you would buy it back again once it passes the moving average. And since its moving average is a reflection of the past 100 days, you're buying it back lower than what you sold it at. So that's giving you, an advantage there. Stock continues to move up. Again, moves below the support, you would sell and then buy again. So it's not, what's a better chart, I would say, is if you could have two moving averages. You could have a 100-day and a 200-day. So you could use the 200-day as a support level, the 100-day as a resistance level. So you can kind of, encapsulate a stock between two moving averages to better establish the resistance and support levels. Okay. So, of course, technical analysis is something that I believe is more useful the more experience and the more practice and the more observations you've made in charting, in patterns, in looking at these technical indicators. I've certainly spent a lot of time studying technical analysis, applying it to stocks, and I've found that it doesn't necessarily tell me which stocks are fundamentally good stocks to own. That I would use fundamental analysis for. But on occasion, it's helped me to understand that this would probably be a good buy-in point for the stock, because the stock may have a very low RSI. The stock may have just penetrated a breakout through its resistance level. So this could be reinforcements that I could use for giving me confidence to buy a stock. And I have to say that over time, I've been pretty successful utilizing the technical analysis along with the fundamental analysis. But with anything, you shouldn't really trade real money with this until you've had time to study it, observe it, and then maybe practice it in a stock trading simulation to really see, does this work for you? Are there certain things that you have been picking up in the patterns, and can technical analysis be a tool in your stock trading portfolio? Okay, this concludes Chapter 9. I hope you enjoyed this chapter, and I'll talk to you again soon with Chapter 10.